Assalamualaikum warahmatullahi and welcome everyone. In this video, we will be talking about accounting for another item of current assets, which is inventories. Our goal is to understand the definitions of inventories, to understand the recognitions and measurements of this type of asset, understand the two different systems in recording inventories and valuing it, as well as how we shall report inventories in the financial statements. We will be referring to two standards. For definition, recognitions, and measurements and disclosure, we will be referring to MFRS 102 inventories. And for presentations on the face of financial statements, we will be referring to MFRS 101. Just to highlight to you again, in case you are still wondering, disclosure is referring to details of an item on the face of financial statements reported in note to the financial statements or notes to the accounts. Presentation is referring to how should an item is presented or displayed on the face of the financial statements. These are part of the typical guidelines given by the standards other than scope of the standard. Let's start with inventories under MFRS 102. For the definitions of inventories under MFRS 102, first, it must be an asset. And there are three types of this asset group that can be regarded as inventories. A, held for sale, meaning we acquire or we produce that particular asset with the intention to sell it to third party. B, assets that are in the process of productions for such sale are also recognized as inventories, since the end objective of producing that asset is still for sale. And C, assets that are in the form of materials or supplies, either to be consumed in the production process or in the rendering of services. So if we manufacture cars, for example, tires that are still unused will be part of raw materials inventory. Or if we have paint to be used in our painting service, that is also an inventory to our business. Basically, definition A is referring to finished goods, definition B is referring to work in process or progress, and definition C refers to raw materials. The second important definitions for inventories is net realizable value. In general, it can mean how much can we realize from an item, which means how much can we get if we were to convert it into cash. Like when we say how much is the net realizable value of accounts receivable, it means how much can we collect from our debtors, i.e. convert the debt into ringgit and cent given bad debt. So specific for inventories, net realizable value or NRV means how much cash can we get from inventories after deducting the cost of converting it into cash. Specifically, we calculate it by taking the estimated selling price minus estimated cost of completion and the estimated costs necessary to make the sale. The estimated costs necessary to make the sale may include cost to repair default products returned to us by customers, or cost of repackaging the goods if, say for example, the original packaging was damaged by water due to flood. Bottom line is how much net cash that can be realized from the selling of the goods after considering costs to enable it to be sold. As for the measurements of inventories, this refers to what value should be reported in the financial statement, specifically the statement of financial position. In paragraph 9 of MFRS 102, it says inventories shall be measured at the lower of cost and its NRV. So initially, when we record inventories, whether from productions or from purchase, we will record it at cost. But at the end of financial year, or whenever necessary, we will need to assess if the NRV is lower than its cost. If yes, then we shall adjust the value to be equivalent to NRV. Otherwise, its value remains at cost. Now, this is as such because of the recognition criteria. We can only recognize it as asset if the value is probable. So if the value of inventory at cost is no longer probable, meaning when we sell it, we cannot even recover the cost, then the amount is no longer probable. So we need to adjust the value to be equivalent to the amount that is probable, which in this case, the NRV. Again, net realizable value is the amounts of net cash that we can get from selling the goods after considering costs that enable it to be sold. In paragraph 28, it explains that cost of goods can increase to be higher than the NRV in certain conditions. For example, the goods are damaged, thus we need to incur additional costs to bring the condition back to where it can be sold. Or, the cost of producing the goods, for example the cost of raw materials, has increased significantly. That makes the total cost to be higher than the selling price of the goods. So in both situations, we would not be able to recover the cost of the goods. Thus, realizing cost is not probable anymore. Later, if the NRV increased to be more than the cost, then we shall record it back at its cost. And we need to do this. We need to do the assessment at every end of year or whenever necessary. So this is a potential source of adjustment that need to be done at every end of financial year. Just to give you an overview of the whole discussion, in terms of measurement, the standard requires us to measure inventories after initial recognitions, either at cost or net realizable value, whichever is lower. Under cost, you can either use FIFO, LIFO, or weighted average methods. These are the valuation methods to measure inventories under cost at the end of the financial year. And then we have the recording part. We call it as inventory system or inventory recording system or inventory accounting system. And for this recording system, we can either choose to apply perpetual system or periodic system. Under perpetual system, we will have an active inventory account where we will update the account every time there is a purchase of goods and sale of goods or inventory. Under the periodic system, we will have somewhat inactive inventory account where we only update the account with the balance of inventories at the end of a period. Thus the term periodic, that is when we do stock taking. Now stock taking simply means we go and do physical counting of inventories in the warehouse and determine the amounts and value available at the end of the year. Only once, or at least once. So in terms of measurement, we will refer the standards MFRS 102. With an exception, LIFO is not recommended by the standard. And in terms of its recording system, this depends on business practices. Let's first look at the measurement under MFRS 102. Paragraph 10 of the standard guides us on the costs that are taken as the cost of inventories. It includes cost of purchase, cost of conversion, and other costs in bringing the asset to their present condition and location. For cost of purchase, paragraph 11 further explains what constitutes of cost of purchase. It shall include the price of the goods that we purchase from suppliers. And if we purchase the goods from outside of Malaysia, we might be charged with import tax or duties. So these two charges shall be included as cost of the inventories. If there are other costs incurred in relation to the purchase of the goods, all of them shall be also included in the determinations of costs. For example, if we have to pay for transportation services, or if the goods require special handling that cost must be paid by us, then this shall be included as cost of the inventories. Also, if we are given discount, which will reduce the amounts that need to be paid to suppliers, we also need to account for this reduction. For cost of conversion, Paragraph 12 explains about it, where it shall include direct costs and indirect costs. These are typical groups of costs that are incurred to convert raw materials into finished goods that can be sold. You will learn the details of this in your costing and management accounting courses. As for other costs, paragraph 15 explains that it shall be the cost to bring the inventories to the present location and condition. Present location would include the transportation cost to bring the goods to the current locations or to our warehouse. Present condition is referring to the condition where the goods are ready to be sold, which may include special storage costs, and if we manufactured our own goods, we might also include the abnormal amounts of waste produced as a result of the production process, but the amount must be significant enough to be included in the cost. In this example, we have 200 units of finished goods purchased from suppliers at 3,000 ringgit, and as that date, the net realizable value is equivalent to 3,200. So the goods are recorded as inventories since the intentions of purchasing them is for resale. The cost recorded shall be at 3,000 since it is lower than the NRV. Therefore, at initial recognition, we shall recognize the purchase at 3,000 ringgit by debiting purchase or inventory account, depending on the accounting system applied, and credit cash or accounts payable. Paragraph 25 of the standard explains that cost of inventories shall be determined using either FIFO or weighted average formula. We are given the choice to use either one, but whatever valuation method that we use, we must use it consistently throughout similar inventories. For example, if we have goods that are consisting of food and beverages, and we choose to use or apply FIFO formula to it, that means for every fresh produce, cereals, soda drinks, every item that fall under the same category, we must use the same formula to determine the cost at the end of the year. Just for your information, although the standard only recommends FIFO and weighted average, generally we also have LIFO and specific identification of cost methods to determine costs. Further, the standard requires the recognitions of expense in relation to inventory for two different situations. First, when inventory are sold, the carrying amounts of inventory shall be recognized as expense. In this case, it shall be recognized as cost of goods sold. And it shall be recognized in the relevant period where the related revenue is recognized. Meaning, if you sell the goods in the financial year 2021, the carrying amounts of those sold inventories shall be recognized as expense, or specifically cost of goods sold, in the financial year 2021 as well. Another situation that we shall recognize inventory as expense is when we reduce the value of inventory from cost to NRV. So part of the value of inventory will be recognized as loss in inventory as expense, and again, it shall be recognized in the same period when the write-down or loss occurs. The reduction in value of inventory also denotes that the portions of the cost is not probable to be realized anymore. And if the inventory that has been written down has a reversal, meaning the net realizable value has now increased and exceed cost, so we shall reverse back to cost value, we shall reduce the expense previously recognized as loss in inventory to reverse the action in the same period where the reversal occurs. This is to denote that the portions of cost that was determined to be not probable has now become probable. Please note, the standard will not tell us what account to be debited or credited, because that is obviously very basic bookkeeping. Therefore, there will be few ways for us to reach to the same objective given by the guidelines in the standard. For example, here we are told to recognize expense, and for the first one, That is the journal entries if we were to apply perpetual inventory accounting system. We recognize expense every time we do sales. For periodic inventory accounting system, we do not recognize directly every time we do sales, but only at the end of the year. Regardless, both systems comply with the standard guideline that requires to recognize inventory as expense in the period when the sales is made, which is in the same financial year. So both recording systems comply with this requirement. In future discussions, whether in this course or future FAR courses, you will discover the same thing. As for the disclosure, these are the information that you must declare or report in the notes to the financial statements where relevant in relation to your inventories. For this, you may read them on your own as they are fairly direct. In terms of its presentation, as per MFRS 101, presentations of financial statements, inventories must be presented on the face of the statement of financial positions as in paragraph 54. And it shall be presented under current asset as we acquired or produced them with the intention to sell for the purpose of trading and are expected to be realized or converted into cash within the next 12 months. Such is the requirement in paragraph 66 of the standard. However, if the inventories are expected to be realized within more than 12 months, it shall be presented under non-current assets. To illustrate the disclosure and presentation, we will be looking at Saudi Group's annual report for the financial year 2021. Saudi Group is listed in the main market and is under consumer products and services. For your information, Saudi Group manufactures processed food under Saudi Gold brand. I think you are familiar with this brand. You can find its products in the frozen food sections at the supermarket. This is a sample statement of financial positions of Saudi Group for the financial year ending 31st July 2021. As you can see here, inventories is presented under current asset and there is a note number 10 that will explain about it further, which is referring to its disclosure. And when we refer to note number 10, we know that the inventories consist of raw materials, packing materials, work in progress, and finished goods. So we know that Saudi Group involved manufacturing activities. And all of the inventories are recorded at cost and not NRV, which indicates that the cost is lower than the NRV. And then we are informed the portions of these inventories that have been recognized as expense due to goods sold, some due to inventories written down in value, some due to damage perhaps, thus written off, and it also has a reversal of the written down value, thus recorded back at cost. So that explains why at the top it only shows inventory at cost and none at NRV. And at the very bottom it explains to us the reason for the reversal. If we compare that to the disclosure for Kamda Group, a trading company, we will have only one type of inventory reported, that is trading goods. And at the bottom, we have information on inventory recognized as expense for the year due to goods sold and written down of value of inventories. So that explains why Kamda Group does not disclose or measure its inventory of trading goods at cost. So in your assignment, make sure that you look for all of these details. What we have discussed so far are some definitions, the recognitions and measurements of inventories, and the reporting of inventories in the financial statements. We shall now move to inventories recording system and valuation methods. Let's start with the inventory accounting system. Before we talk about the system, I simply want to highlight to you that either system can be used with any of the valuation methods. So we can have perpetual system with valuation using FIFO, LIFO or weighted average, and we can have periodic system with the valuations using FIFO, LIFO or weighted average. Only thing, LIFO is not listed in the standard as the recommended method of valuing inventory. Regardless, we are still going to discuss it, just so that you are aware of it. For inventory accounting system or recording system, these are the major differences. Under perpetual system, or also known as continuous system, changes in inventory will be recorded for every purchase and sales made. Meaning, every time you do purchase, we will record an increase in the inventory for the additional goods purchased. And every time we do sales, we will record a reduction in inventory for the goods sold. By doing this, we will be able to determine the balance of inventory in hand after every purchase and sale in terms of quantities and costs. Another feature of perpetual system, it will determine the cost of goods sold at every sale made, which means we will have a cost of goods sold account in our record. So every time you see a cost of goods sold account in a trial balance, it means that the entity is using perpetual system. As for periodic system, there will be no record of changes in inventory account, which means every purchase and sales, an increase due to purchase or a reduction due to sales will not be recorded in inventory account. So this makes the account somewhat inactive as opposed to perpetual system. Due to that, we have to have a purchase account to record a purchase of goods for resale or trading. So every time you see a purchase account in a trial balance, you know that the entity uses periodic accounting system for its inventory. Since no time is made to keep track of the inventory, that means there will be no record of both quantities and costs for changes in inventory throughout the financial year. However, we still need to determine the cost of goods sold. This is determined by physically counting the inventories at the end of the year and compare that with the amount available for sales. The difference will be taken as the cost of goods sold. Let's look at purchase of goods. Say for example, on November 2nd, Zagmart purchased $1,200 of inventory for cash. Under perpetual system, when we purchase inventory, we debit the inventory account for the cost of the inventory purchase and credit cash. This entry is similar to the entry we would make if we purchase any assets like office supplies, a truck, or land. When we make a purchase on credit, it is typical that we offered a trade discount in the credit term. Trade discounts or purchase discount are usually offered when we purchase a huge quantity of goods to encourage us to purchase more and to make payment quicker than the allowable period. For example, here we have a credit term for a purchase, 210 and 30. The term says we will get 2% discount if we pay the full amount owed within 10 days after the purchase. Otherwise, we will have to pay the full amount without discount within 30 days after the purchase. So if you want to have the discount, not only that we need to purchase in greater quantity, but we also need to pay it quick. Now let's see how a purchase discount works. Say for example, on November 2nd, Zagmart purchased 1,200 worth of goods on account with credit terms 210 and 30. In this entry, we debit inventory account and credit accounts payable for $1,200. Now say that Zagmart paid the amount due on November 12th. This means it is within the 10-day discount period. So when Zagmart makes the payment, it needs to only pay $1,176 in cash and reduce the discount amount from the inventory account at $24. the discount amount. In addition to purchase discounts, suppliers or merchandisers, the one that sells goods, will also have to deal with returns of inventory, thus the purchase returns. A purchase return is the return of goods or merchandise by the purchaser to the supplier. Say for example, Z might purchase $1,000 worth of goods on June 1st with terms 210 and 60. 2 days later, Z-Mart returns $100 worth of goods before making any payment. So Z-Mart records a reduction in both its debt and its inventory by $100. When Z-Mart paid its debts on June 11, it takes the 2% discount on the balance of debt. So it records a reduction in debt of $900, a discount for the goods as a reduction in inventory, and payments of cash of $882 minus the discount as settlement of its debt. Now, instead of returning default goods, we might be offered a reduced price by suppliers in order for us to keep the goods. This is also known as allowance. So an allowance is a price reduction granted to the customer because of some quality issues. An allowance may be given because of a slight defect in the merchandise or because a shipment was late. That is also possible to be offered an allowance. In these cases, the customer keeps the merchandise and just receives a price reduction as the allowance. Say for example, Z-Mart purchased $1,000 worth of goods on June 1st with terms 210 and 60. 2 days later, Z-Mart returns $100 worth of goods before making any payments. However, the supplier offered Z-Mart a $100 reduction in total price if Z-Mart willing to keep the goods. Now say Z-Mart accepted the offer, so Z-Mart records a reduction in both its debt and its inventory by $100. When Z-Mart paid its debt on June 11, it takes the 2% discount on the balance of debts. So it records a reduction in debts of $900, a discount for goods as a reduction in inventory, and payments of cash of $882 minus the discount as settlements of its debts. As you can see, the records will be the same for purchaser. Transportation costs are something that we need to look at when determining cost of goods purchased, as it sometimes need to be included in the cost of inventory. For example, when buyers pay transportation costs to get the goods purchased to them, the transportation costs are included in the inventory costs. As per requirement by the standard earlier that we shall include other costs to bring the inventories to the current location, meaning to your location as you are the one who purchased the inventory. FOB or free on board terms will tell us when title passes and who pays the transportation costs. Now, if the shipping terms are free on board shipping point, that means the ownership transfers from the seller to the buyer when the seller provides the goods to the carrier. It also means that the buyer will pay the transportation costs. These transportation costs will be added to the inventory account as part of the cost. On the other hand, if the shipping terms are free on board destination, that means the ownership transfers from the seller to the buyer when the buyer receives the goods. It also means that the seller will pay the transportation costs. In the example shown here, the FOB term is shipping point. Therefore, the moment the supplier placed the goods in the carrier, that is when the title of the goods passed to Z-Mart. Therefore, Z-Mart will have to pay for the transportation costs, and therefore will be part of the cost of inventory. Just so that you know, we also have a term CIF that stands for costs, insurance, and freight, which is another term for transportation. and usually used when it involved significant cost of transportation, like from one country to another. Regardless, the terms and conditions will be determined by suppliers and can always be negotiated unless it is fixed. Overall, the journal entries for Perpetual accounting system for inventory will be as follows. And remember, under Perpetual system, we have an active inventory account. We record the changes in inventory account every time we have purchase and sales of goods. So under Perpetual system, when we purchase goods, we record the cost in inventory as part of our asset and record the payment made either only the goods or including the transportation costs. When we receive trade discount, especially for purchase made on credit, we reduce the cost of inventory by the amount of the discount. Similarly, when we return goods purchased, we will record a reduction in the amount of inventory. Under periodic accounting system, when we purchase goods, instead of recording the cost in inventory account, we record it in purchase account, while the rest of the journal entry is the same. When we receive trade discount, instead of reducing the discount amount in inventory account, we create a discount received account as a contra account for purchase account. And when we return some goods purchased, we will create a return of goods account. You can see from the journal entries under Perpetual system, everything in relation to goods will be recorded in inventory account. So you can imagine at the end of every transaction, you will be able to determine the balance in inventory account as well as the net amount of goods purchased. But for periodic system, we need to do a bit of calculation, where to get to the net purchase, we need to deduct discount received and returns of goods balances from purchase account balance. Let's move on to sales. For sales of inventory, each sales transaction for a seller of goods involves two parts. First, revenue received in the form of an asset from a customer, either cash or accounts receivable. And then recognitions of the cost of goods sold to a customer. Accounting for sales transactions under the Perpetual system requires recording information about both parts. This means that each sales of goods, whether for cash or credit, requires two entries, one for revenue and one for cost. Now say for example, on November 3rd, Z-Mart sold 2,400 worth of goods on credit. The inventory has a cost of 1,600. Under Perpetual system, whenever a sale is made, the seller must make two entries, one for revenue and one for cost. The revenue entry includes a debit to accounts receivable or cash or bank if it's a cash sale, and a credit to sales. This entry is made for the sales price charged to the customer, which is in this example is $2,400. The cost entry includes a debit to cost of goods sold and a credit to inventory for the cost of the goods sold to the customer, which is in this example 1,600. And then we have sales discount, which as mentioned earlier can benefit the seller by decreasing the delay in receiving cash and reducing future collection efforts. At the time of a credit sale, we do not know whether a customer will pay within the discount period and take advantage of a discount. This means we do not record a sales discount until a customer actually pays within the discount period. Say for example, on November 12th, Z-Mart completes $1,000 credit sales with terms of 210 and 60. The journal entry is to debit accounts receivable and credit sales with $1,000. Assume the account was paid in full within the 60-day period. The journal entry to record the payment is to debit cash and credit accounts receivable with $1,000. Now say that the account was paid within the 10-day discount period. we record receipt of cash with the amount minus the discount. Sales discounts is a contra revenue account, meaning the sales discount balance is deducted from the sales account balance when computing a company's net sales. The journal entries are the same with periodic system. Now just to highlight, for perpetual system, please do not forget to also record the cost of goods sold when we do sales, but for this particular example, we have no information for the cost. Similar to purchase return, we could also have sales return. Say that Zmart's sale of goods on November 3rd for $2,400 had cost of $1,600. Assume that the customer returned part of the merchandise on November 6th, and the returned items sold for $800 and cost $600. The revenue part of this transaction must reflect the decrease in sales from the customer's return of goods by a debit of sales returns and allowances and a credit to accounts receivable for $800. If the merchandise returned to Zmart is not defective and can be resold to another customer, Zmart returns these goods to its inventory. The entry to restore the cost of such goods to the inventory account is a debit to inventory and a credit to cost of goods sold for $600. However, if the goods returns are defective, the returned inventory is recorded at its estimated value, not its cost. Say for example that the goods costing $600 returned to Zmart are defective and estimated to be worth $150. We shall debit inventory for $150 because that is the value that can be realized. Debit loss on inventory $450 for the loss in value of the inventory due to the default, and credit cost of goods sold for $600 to take the amount out of the expense account now that the goods have been returned. Similar to purchase, the seller can make an offer to customer to keep the default goods for a reduction in the overall price. This will save us the cost to make the goods to be in a condition that are saleable at a higher price than the cost. So here, for example, we have Zmart offering $100 reduction for the defective goods, and the customer accepted it. So instead of recording a sales return, we record sales allowance. In this example, Zmart uses one account to record sales return and sales allowance. If you choose to have a separate accounts for discount and allowance, then you will have to debit sales allowance account. Regardless, we still need to reduce the accounts receivable by the allowance. Also, we do not need to reduce the amount in cost of goods sold, since the goods are not returned to us, but instead are kept by the customer. Overall, the journal entries for perpetual accounting system and periodic accounting system will be as follows. Under perpetual system, when we sell goods, we record the asset that we received as revenue from the sales that we made, and at the same time, we recognize the expense for the goods sold by transferring from inventory accounts to cost of goods sold account. When giving trade discount for a credit sale, and we record this when customer made the payment, we record the receipt of cash and record the discount given as part of our expense and write off the discount amount from our debtors account. When customer return goods that he or she purchased from us, we recognize the return on sale and the reductions in our debtors account, and return the cost of goods from expense account to inventory account. Under periodic accounting system, when we sell goods, we do the same recording of receiving cash or recognizing debtor with a sale, but this time we do not update our inventory account. We just stop there. No need to adjust the change in inventory account. When recognizing receipt of payment from credit sale with discount, journal entry will be the same as perpetual system since it does not involve inventory. And when there is a return of goods by customer, Again, it will be the same with perpetual system, at least for the first part, without the need to do the changes to inventory account. And finally, under both systems, we need to deduct discount allowed or sales discount and sales return from sales or revenue account to get to the net sales. And then we have the year-end adjustments for inventories. A merchandiser or trader using a perpetual inventory system is usually required to make adjustment to update the inventory account to reflect any loss of merchandise or goods due to things like theft and deteriorations of value. Shrinkage is the term used to refer to the loss of inventory, and it is computed by comparing a physical count or stock taking of inventory with recorded amount. Let's look at the adjustment due to theft. Say for example, Zmart's inventory account at the end of the financial year 2021 has a balance of 21,250. But a physical count reveals that only 21,000 of inventory exists. The adjusting entry to record this shrinkage is a debit to cost of goods sold to recognize the loss as part of expense to us, and a credit to inventory for $220 to recognize a reduction in amounts of inventory. That is if we were to use perpetual system. Under periodic system, since we do not record changes in inventory account, any loss of inventory due to theft will be automatically included in the determinations of cost of goods sold, since we look at the difference between the available inventory given by opening inventory plus purchase and the closing inventory. So all of the losses, if any, are already captured in the amounts of cost of goods sold. Say we have the same situation, only thing instead of theft, there is a loss in value. So we record the loss exactly the same way. Bottom line, we lost $250 worth of inventory. And again, for periodic system, the loss will be captured in the determinations of cost of goods sold at the end of the financial year. This chart shows the flow of merchandise costs during a period and where these costs are reported at period end. Specifically, beginning inventory plus net costs of purchase is the merchandise available for sale. As inventory is sold, its cost is recorded in cost of goods sold in the income statement, and what remains is the ending inventory in the statement of financial position. For a periodic system, we determine the cost of goods sold by using the formula opening inventory plus purchase minus closing inventory. And please note that a period's ending inventory becomes the next period's beginning inventory. For the closing entries for inventory, under perpetual system, we have several temporary accounts with one temporary account that is unique to perpetual system. We have sales account, sales returns account, sales discount account or discount allowed account, and cost of goods sold account. The cost of goods sold account will only appear in the book of accounts under perpetual system. In the income statement, we will have sales, that is net of discounts allowed, and sales returns, and deducted from it the cost of goods sold amounts taken from cost of goods sold account. Then from it we get the gross profit. Just for your information, the top part of the income statement to get to the gross profit was once known as trading account, and the bottom part from the gross profit to getting to the net profit was once known as profit and loss account. Under periodic system, we have several temporary accounts with 3 temporary accounts that are unique to periodic system. We have sales accounts, we have sales returns account, sales discount account or discount allowed account, and then we have 3 unique temporary accounts under periodic system that are purchase accounts, discount received account, and returns of goods accounts. In the income statement, similar to Perpetual system, we have the sales that is net of discount allowed and sales returns, minus from that the cost of goods sold. But this time, it is determined by adding the opening balance of inventory account to the balance in purchase account to get to the available inventory for sale, and deduct from that the closing balance of inventory account that we get from doing physical counting or stock taking of the inventory, and that will give us the gross profit. In terms of journal entries, we credit the inventory account with the opening balance amount, thus making the balance to be zero, and then we debit inventory with amounts from the stock taking, making the balance to be equivalent to the closing amount. And that is how the opening and closing inventory amounts appear in the profit and loss account instead of cost of goods sold account. So this is the end of inventory accounting system. Please rewatch the video if you think you missed anything. In the next session, we will continue to discuss the valuation methods of inventory. Until then, wassalamualaikum warahmatullahi wabarakatuh.